not knowing I made a mistake by buying the land before I had all my entitlements. Okay. Uh, Mistake 101. All right. So here I was pressured by the sellers to purchase the land, and I was excited. And Austin's growing, and I can see what's happening. But I went ahead and bought it, and I mean, 90 days later, the financial Armageddon was starting. Um, I had a term sheet from a very well-known, reputable national lender. They called and said, you know what? We're shutting the doors. We're out. I go, wait a second. Yeah, here's my money. He said, sorry, sue us. They were out, they were on CNBC and everything. And I'm like, oh my God. Uh, but what I did, when your back's up against the wall, you've got to figure things out. And you got to stay calm because there's solutions out there. There's solutions. You just have to be resourceful. Well, what we ended up doing is I learned about a insured lending product that I'd never even heard of before. And that was loans that were insured by HUD, by the federal government.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio. Thanks for joining us. My name is Darin Davis. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Darin Davis. Darin is a real estate leader with 20 plus years of experience and has led through market shifts with over $1 billion in projects. And he's co-founded Club Capital. And in just a minute, we're going to speak with Darin Davis about multifamily syndication opportunities in 2024. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Darin Davis. Welcome to CREPN Radio.
Thank you, Darin Gross. I enjoy meeting another Darin always. There's so few of us.
Yeah, true.
Yeah.
But no, delighted to meet you and make your acquaintance. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah. It's probably a lot like many people that are listening. After graduating college, I kind of did a traditional, kind of sales job and started working my way up. And I spent 15 years in finance and software. So loved everything I was doing, loved the whole sales process. It was out in San Francisco working for a couple of startups out there, to include Yahoo at the time. But what I found out after about 15 years of that, I started realizing that, man, I don't have control. I mean, I was controlled by VC companies. I was controlled by executive management. And I just sat back and I said, I got to do something different. And I didn't know what it was. I truly was just, I wasn't smart enough to go, oh, here's my path over here. But I had a couple of, when you have a life event, like my father passed away, and I was just going like, all right, I got to figure this out, So I just put the brakes on it. And I kid you not, I'm sure this story has been told a million times, but I'm driving down the highway from San Francisco to San Jose, and I'm listening to an AM talk radio show. And this guy comes on talking about real estate. And I was going, okay, this is interesting. So I have an hour commute. So I'm listening. And it was Robert Kiyosaki, Rich Dad Poor Dad. Never heard of the guy. Didn't know anything about him. Didn't know anything about real estate. Didn't know anything. But I was fascinated by the concepts that he was talking about. And I literally, there was about 15 minutes left in the radio show, and I'm sitting in the parking lot of my office building, and I'm going to finish this radio show because I didn't have a way to record it. I didn't have a way to go back on the internet and listen to it. And I swear to you, that afternoon, I literally went to a bookstore and tried to find this Rich Dad Poor Dad book. I don't know if I found it that day, but within a week or so, I found it and I just became fascinated by it. And I said, this is it. I said, I don't know what it is, but it's going to have something to do with what his base principles were in here. And I give that book or that interview or that radio program a lot of credit. Now, granted, I was looking for a solution. So when I heard that, I just said, bingo, that's it. Let's go. And I mean, I literally put a plan in place to leave my job within a year later. And I realized California was not probably where I wanted to, test my wares in real estate just because it's California. So relocated back to Texas where I'm from, and that's where the story started.
That's awesome. Now the Rich Dad Poor Dad and all of Kiyosaki's books. I think there's one there's there's one that has the quadrants that really resonated with me, but all of them there's that inspiration in them. And more the story. I mean, especially if you're not exposed to that or even that entrepreneurial mindset, but you're on the path that everybody tells you, go to school, get a job, work for 45 years, then retire. Uh, you're really kind of at a loss to where are you going to find the inspiration or the motivation or even just the insight on the powers of investing on your own or creating your own vehicle. So that book gets a lot of press and for good reason.
Yeah,
So
it was interesting because, and I'll tell you the other thing that if you're going to have a pain point in your life, and it may be when you're 30, it may be when you're 50, could be when you're 18, but I remember when I was making life changes, I just knew that my days were Monday through Friday working for somebody else and probably half a Saturday, if not half a Sunday, getting ready for the next week and traveling. But I remember it all came to a head when I got a tax bill for $400,000. Now I'm 36, 35 at the time. And then within this next few months, my father passed away. And I just said, okay, these are serious pain points. My dad was a corporate guy all the way through. Kiyosaki, this whole tax bill, I got to figure out how to not pay 400 grand living in the state of California, and which I didn't know. I was a W-2 guy, a sales commission guy. And I said, man, I busted my butt and it feels like my cost and my taxes and just everything to exist or I'll never get ahead. So that was, it hit me so hard. I knew I had to do something different. So that's what launched. And here we are 24 years later, telling people that it's the absolute best decision I ever made for me, my family, everything.
no, that's awesome. No, it's interesting. You mentioned pain though. It's necessary. I mean, there's lessons that are learned in pain,
Mhm.
and you seek solutions when you have pain. Without it, you're not motivated to find a solution. And so there is a value to pain, although we don't. I prefer not to be in pain, but there is usually a uh, a value there. So good to hear
Yeah,
that. So
pain and loss. Those two things will motivate you quickly.
yeah, absolutely. So you've been doing this now for 24 years, the real estate?
Really started. I'd say I got real serious about it in 2002.
Okay.
I dabbled in it in 2001, dabbled in it a little bit in 2000. I was still an employee through 2001, through September 2001. So I didn't make the full switch until 2002. And then from there, I never looked back.
So tell me about your dabbling. What were you doing when you dabbled?
Probably like most people, I started off with a single family home, because it was, I could qualify for it, and I didn't know how to raise capital. I didn't know how to qualify for loans. I had owned a house earlier, probably 5 years earlier in Texas, and so that was my knowledge of debt and mortgage and single family. So, and I think it's a great journey because I started off with a couple of single family homes. Found out quickly that self-managing was a terrible idea. Okay. Because I still had a job. And I just, I think I had at one time 5 of them, but I do remember that towards about the third year of owning these, I said, okay, I have 3 of them. I told the broker, I said, I'm out. I said, get rid of them. I'm doing something different. So, and it's an evolution process. I realized that I needed that education by going through that single family process. Did I make a little bit of money? Yeah. Did I get a lot of knowledge and hands-on experience? Absolutely. So I wouldn't ever discourage anybody from starting with the single family home to the duplex to the quad, just like the game of Monopoly, and just kind of grow your way into it, because I learned something that I could carry forward. Now, this is the other thing, and people don't like to hear this, but the best education I ever got is when my own money was involved in the deal. And I didn't always make money, and there's a cost to education, whether it's courses and mentorships you sign up for, or if you put real money into a deal, single family, duplex, quad, whatever, and you do not make the profits per your pro forma, which we all can make profits on a pro forma spreadsheet, or we wouldn't go into the deal. But it's not perfect, especially when you're in your learning years. So, but I do know now, people like you and education systems that are out there and the internet, you can compress that learning time. If you're serious about it, I think I probably got fairly knowledgeable in year 7 or 8 when I had gone through a lot of transactions and different types of assets. I think that compression time, if you execute, not just read books, but if you actually go out and do it, you can compress that learning, curve by 50%.
Yeah, absolutely. No, and having your own skin in the game is definitely, I think it's required to really to pay attention.
Yeah.
If you're merely just putting money in a fund or whatever, and I don't say that that's not a viable vehicle. I mean, I'm sure you guys raise a lot of money doing what you do, and you probably have a fair amount of people that just are looking for a place to park capital. But for somebody getting started that's really trying to grow a portfolio or wealth in real estate and to understand how real estate works, I know when I first did, I didn't understand depreciation. I mean, it
Yeah.
wasn't until I did my first taxes, our first tax return after I was like, holy crap, because that's not something they tell you or you get when you own a home,
Yeah.
kind of thing. And just how, what a gift that is to real estate investors as far as, a way to reduce your taxes. And then,
Well, that's that $400,000 tax bill I got that year. I just said, I got to figure this out. That's a lot of money. And,
yeah,
and that was in 90, I want to say that was in 99.
yeah,
So that to me back then, that was like a whole, I was like, wait a second, and it was back under Clinton's administration. There was a phantom tax, I didn't know what I didn't even know what a phantom tax was. I didn't know what depreciation was. I didn't know anything, but I learned it quite quickly. And that's that pain point we're talking about. That was
right,
painful. So
right. So you dabbled in some single family, realized the limitations there, made a decision to get out of that. You said you went into some other asset classes. What other asset classes did
yeah,
you?
I think this is where the journey really is foundational. I was so determined. Now, I had left corporate America, so I'm on my own. Okay. Recently married. I've got 2 infant children, 1-year-old and 3-year-old. And I was just like, I've got to figure this out. So I was pretty diligent about sourcing relationships, contacts, networking, and I give this guy a ton of credit. But fortunately, I met a gentleman who was doing syndications. Which, when he told me what he did, I immediately thought, well, I don't want to be part of the mob. I just want to learn real estate. I didn't know what a syndication was. And he explained it to me, and he said, look, if you think you can raise X amount of dollars, he goes, you can come in with us and you'll share in part of my promote as a sponsor, and your investors will do this and you'll get this. And I said, okay, I'm interested. So I ended up doing 13 Class B retail strip centers. And his business model, now I participated with him. He was the lead GP, and he secured all the debt. But we ended up doing that model all the way up, and our final one was sold in 2012. But the first 12, we made really good profits. Our investors did well, sponsors did well, and he was a natural for finding a strip center that was a mom and pop owned, and he would go in and re-tenant, repaint, get the value up and turn around and flip it within 2 to 3 years. The reason I said we went 12 for 12 is because the last number 13 we bought at the end of 2007, and we know what happened in 7, 8, and 9. And we actually held that through 2012, and it was the only one that we were not like seriously profitable. We hung in there. We did what we could. We got a big chunk of our capital back. I mean, the majority of it. But the lessons I learned from him on syndication and how to add value were paramount. In fact, I did my first syndication. I picked another great year to do it. I did it in 2009, but it was not by design. My back was against the wall, and I had to figure out a way to not lose money on this deal. And so with the help of some really creative friends and people in the industry, we were able to take an asset that most people would have walked away from and just lost $1 million. We ended up not walking away, and we figured out a way to turn that into one of our best investments we ever did.
Well, a couple things I want to hear more about. One is I'm delighted to hear that you were in a full cycle, because I think that as here we're recording this in May of 2024. A few years before here, so like probably back, I started doing this podcast in I think 2015, and for the longest run there, everybody said, "Oh, we're in late innings of the cycle," kind of thing, and then a couple of manipulations of the Fed or whatever, or COVID money or whatever, kind of extended the game into like a double header, and everybody that got in was doing well. And clearly now we know that the Fed rates have gone up, and how critical your cost of capital is to the success of your project. And things are different now. And you've got people that maybe got in with a plan, not anticipating the market change, and now they're either potentially giving the keys back or trying to explain to their investors how they're not making the money that they thought they'd make, or what have you. And for you to have actually been through that is, you're one of few people I've talked to as a guest on this podcast that have actually been through a down cycle. And I think that lesson probably would give you more credit than most, as far as if somebody's looking for somebody to invest with, to hear your story and how you did weather it, and that you didn't just hold up and disappear and nobody could find you, kind of thing.
Yeah, well, first of all, you just told me I was really old, so
Well, experienced.
no,
Yeah, yeah.
no,
You're a veteran.
I treasure it now. Okay,
Yeah, yeah.
because I'm not making the mistakes I did 15 years ago. So, that's it's a good thing. I'll tell you a little bit about on that transaction, how we took that from I thought it was just underwater, we're losing our money when it first kind of got bad in 2009, I think, maybe late 8, 9. But not knowing I made a mistake by buying the land before I had all my entitlements. Okay. Uh, Mistake 101. All right. So here I was pressured by the sellers to purchase the land, and I was excited. And Austin's growing, and I can see what's happening. But I went ahead and bought it, and I mean, 90 days later, the financial Armageddon was starting. Um, I had a term sheet from a very well-known, reputable national lender. They called and said, you know what, we're shutting the doors, we're out. I go, wait a second, yeah, here's my money. He said, sorry, sue us. They were on CNBC and everything. And I'm like, oh my God. Uh, but what I did, when your back's up against the wall, you've got to figure things out. And you got to stay calm because there's solutions out there. There's solutions. You just have to be resourceful. Well, what we ended up doing is I learned about a insured lending product that I'd never even heard of before. And that was loans that were insured by HUD, by the federal government. So, sometimes these HUD insured loans have a bad rap, and sometimes they're the best thing ever because lenders were willing to lend to people like myself if the government would back the loan. So, for the next 2 years, I think HUD insured loans were the go-to, loan product because other lenders were either shutting down or sitting on their hands and they were holding all the capital they could possibly hold. So one is I learned about the HUD insured loans, which gave me a lifeline. Two, living in the city of Austin, we had recently, like 2000, right after 2000, the city started experiencing a lot of growth. A lot of the high tech companies were relocating here. Cost of living, a lot of talent, university here, state capital. So you started seeing a lot of net migration, from this old hippie town to this kind of high tech town. And it literally put Austin, I think, on the national map just because there was a lot of things that were very favorable to Austin, and I could see the growth happening. And so as the growth happened, that started putting a pressure on housing. And our affordable housing, all of a sudden, which was affordable, was not affordable anymore. So, the city is looking for ways to help provide affordability. Well, they have passed a bond, and there was money in this bond to do affordable housing. So I worked with the city of Austin, I worked with HUD, and we were able to find a way to provide affordable housing, find a way to do construction debt, find a way to do permanent debt, and hold that asset for an extended period of time. And in 2010, we were the only multifamily project in the city of Austin to come out of the ground. And so there had been no supply for like the last 18 months, but the demand was just kept going up, kept going up. We fully leased 240 units in 5 months.
Wow.
There was such a demand, and we had an affordability component to it. We held that asset for 12 years, and still to this day, one of the best assets we ever did. And at the beginning, I thought I was done. I thought my first syndication deal, on my own with a multifamily was going to bury me because of timing and market. I couldn't have picked the worst time, but we got through it. I had great partners, great team. We got through it, and very proud that I think the lesson I learned out of that is there's always an answer. There's always a solution. It might not be right in front of you, but if you're resourceful enough and you're determined enough, you'll find that answer. Yeah. And it was, and it was painful. But we got through it, and it was, I didn't really make any money on it because I wanted to make sure my investors, I didn't make any really money on it in the first few years because I wanted to make sure that I kept my word to my investors. And then once my investors were profitable and they were getting their returns, then I started making money. And, it was tough, but it was very rewarding from an education standpoint, a relationship standpoint, and a financial standpoint.
No, that I'm certain that your investors are pleased with the outcome there, and also I think that probably goes a long ways to uh, giving you runway for additional investors or to reinvest in your, your future projects, knowing that you did what you did. So I would think that, again, your experience is kind of a badge of honor from a standpoint of that, people looking to invest and they're vetting potential sponsors, want to make certain that where they're putting their capital, that somebody knows what they're doing or has seen this before, or is resourceful. Like your story clearly shares that you've faced you've had your back up against the wall a couple of times here and figured out how to survive and make it work. So that's good. So let's talk a little bit about, so you had your first project, and that was it affordable housing in the true sense of LIHTC, or was it just more of a local kind of a what was considered affordable, or how was that set up?
Well, it wasn't done with like the 4% or 8% tax credits. It was fairly new concept. So there was bond money that was allocated to support affordable housing. So it was a public-private partnership. So we had market rate units, and then we had affordable units. And for that affordability component, we had a reduction in our property taxes. So to offset that. So we had some units that were at what's called 30% median family income, some at 50, some at 80. So there was some discounts and then deeper discounts. And it was all based off of, us not paying property taxes. But the city of Austin said, look, we're going to pay for it one way or another. Okay. If you've got the units and you want to negotiate a favorable tax rate, then this is what we want for the affordability component. So, we came to the table with affordable units immediately, leased them up immediately. And I got to tell you, people always ask, oh, affordability, oh, Section 8, oh, whatever. I'm going like, guys, our tenants in our affordable units going into a Class A apartment complex were some of the absolute best tenants we had for years and years and years. They were grateful that the city assisted them in getting housing in a brand new, highly amenitized apartment complex, something they probably couldn't have gotten on their own. And they were some of the best tenants we had as long as we owned the project. I mean, we had people there 10 years easily, and with great pride in taking care of the complex. So when you talk about affordability, and what we do, and we have other projects that are going down the affordability component, and we may talk about that a little bit later. But it's not. Well, let me tell you what it is. It is a wonderful solution, and I wish we could do more of them and faster. It's just such a slow process, but once you get into one as an owner operator or an investor, you have a high probability of being financially successful because of the way the affordability component is run. It's a win-win for both parties.
Yeah. So in that particular deal, was there any obligation to commit to a length of time or for those tax abatement as far as the property taxes, or what was the structure of that?
Well, I'll give you two answers. The evolution of this product type today here in the state of Texas, it varies. You see it anywhere from 15 years to 99. And there's differences in the way the structures are set up. But the way we did it at the time, the actual dirt was deeded affordable. So it was a 99-year affordability component on the dirt. Now there's projects today that, okay, the sponsor can pick up the property taxes, pay a fee, and take the whole thing back to market and forego the tax exemption or tax abatement. So there's multiple different things that are out there today. But back in the day, back in 2008 and 9, it was more a 99-year ground lease, to get the affordability. So, but that's changed a lot because a lot of people are going like, wait a second, that doesn't make sense because the market and the demographics and everything had changed in 15 or 20 years. Let's put put some parameters around that and reevaluate it 15, 20 years later.
No, got it. So you did your first syndication where you were the GP. Uh, where are you since then? What's going on?
Well, let me fast forward to let's just bump it up to the last 5 years, 5 or 6 years. What's
Okay.
happened, and that'll put us into the current market. So we are our core competency is we're not a general contractor and we're not a developer, but however we do co-develop. And so we do have some skill set that can, help in the development cycle or the development position, but we are primary a equity group and we will fund the developers equity needed, sometimes 90%, sometimes 50%. We may JV with another equity group if it's a, 20, $30 million raise, maybe a little more than we can do, but we can hit that 10 to 15 million fairly consistently. But what's happened is being on the equity side, we, LP equity, the development, and we were funding developers. The development is virtually halted in the last 18 to 24 months. In fact, we're at, we're coming up. Our last one we did was about 20 months ago because it just didn't pencil. I mean, the valuations were coming down, the interest rates are going up. The capital stack or the leverage from the lender had gone from 75 to 55. So all the numbers, it just didn't pencil. So we kind of sat on our hands for a little bit and said, let's wait and see how many rate hikes we're going to have. Are the supplies and material costs going to level out? What's going to happen here? Valuations coming down. We have a little bit of overbuilt, especially here in Texas for today in certain areas. So we just kind of sat down, but then we also looked at, all right, what's the issue that's about to happen? And we noticed about 2 years ago that the world that we're in is the world that's about to take a punch in the nose and is starting to right now. All of these developers that took out these loans at a floating rate, 3, 4 years ago at 3.5% are all now at 8%. All right. So that interest reserve that they projected and funded is now gone. All right. And instead of the rents being $2 a foot, now they're $1.70 a foot. So you start seeing, oh hell, this is quicksand. I got to figure out how do I make my shoes a little bigger, a little wider, stay up a little longer. And what's happening is they're needing this gap of money, which we refer to as preferred equity. Now, bear with me. Let me try to give a quick explanation. Pre-2001, you had really two sources of money that would go into a capital stack for an apartment complex. You had the bank debt, which is the senior debt, and then you had the common equity. And usually it was 75% bank, 25% common. Real simple. Everybody's been doing that since 2010, okay, 2011. Well, now that the markets are incredibly destructive to the investor, that model's not working, but these developers are still, coming to the end of their construction project and they have lease up. Well, they're needing an extra 2, 4, 5 million to get it over the goal line. And so what's happening is we are providing this slug of equity, say, $2, $3, $4 million to cover interest reserves, debt service coverage, and finish up the lease up. And it's called preferred equity. And what happens is that goes right in between the senior debt and the common, and you have a priority position over the common equity. So you are fully recapitalized and paid out before the common equity receives anything. Now, what's happening here is that if you look at this rescue capital that's coming in, a lot of the common equity investors are saying, look, we got a capital call. We don't really want to put more money into the deal. So they're saying, if you can go out and find a group that'll put that in, yeah, we'll sit behind them. So what's happening for us, our investors are getting in a really secure position, above all the common equity or in front of all the common equity. They're getting a double-digit return, probably closer to 12% paid out, annualized paid out quarterly, and they're fully capitalized before the common equity receives anything. So you're getting this big safety net behind you. Now, why do I like this right now? Well, right now, if you're sitting on the sideline doing nothing with your capital, it could be the right thing for you. But if you've got all your capital doing nothing, probably going to lose money, but that's fine. You may, if I lose 5, 6, 7% a year just on inflation, and not being in the market, you can go to a treasury, you can go to CD, you can go to money market, but these preferred equity slugs that we're putting in there are right around 24 months. So I call that short term. I call that fairly liquid. You're not in a deal for 5, 6, 7 years. We come out of that and we're getting a front row seat to every asset that we're investing in. So we get paid to sit on the front row and watch the property management, watch the asset management. And every one of these that we're doing, we're underwriting like we want to own it, because eventually I hope we do. I hope, a year to 2 years comes around from now and we're looking at the sponsor or the developer saying, hey, you know what? We understand the asset. We're already in it. We would like to go ahead and make an offer to purchase this asset, and we'll minimize your time to sell. We'll minimize a lot of the fees that would go into this. We already know the asset, so we plan to be in that position. Now, we're going to try to buy them all? No, because we'll see, being on the front row, we'll see which ones are performing, which ones aren't. We'll be able to get all the data around us, and we're very, very data driven. But what markets are bringing in more jobs, more money, more demographics that fit the apartment profile that we're looking for. So if we're in the right position at the right time, we're going to be like we were in 2008 and 9 and 10. That's when we were in the bottom of that trough, and it just felt horrible, but anybody that was investing in 11, 12, 13, 14, 15, 16, you saw a rocket ship, hockey stick, rocket stick growth in valuation and rents. I firmly believe with the lack of new construction last year, this year, and next year, the supply is going to be absorbed all the way up through the end of 25 and 26. I think the back half of 26 and 27, I think we see that, not rocket ship, but I think we see a nice hockey stick effect for multifamily investors. Valuations will start going up because the demand is there, because no new products being developed over the next 3 years. And you're going to see a really nice return on your investment if you start looking at getting into deals back half of this year, 24, 25, and 26. I think the next 6, 7, 8 years will be incredibly profitable for investors in the multifamily space.
Yeah. So a couple of questions on the preferred equity. You mentioned the common equity is basically saying, hey, look, we don't want to contribute more to meet the capital call. So when you come in, are you essentially diluting their ownership, or how is that? Because your equity.
Mm-hmm. That's a great question. Yeah. You know who gets diluted on this? The sponsor, because think about it. They're the last ones to get paid. Okay.
Right.
So what happens is you've got most all of the common equity has a preferred return. All right. So that's contracted. And then after that, it goes through a waterfall on profitability. Well, if the first person to get diluted is going to be the sponsor. So the onus is still on the sponsor for performance, because if they're not going to make any money, then, they start going, you know what? I got to figure out a way to get my investors paid, and I'm just not going to make anything. Or the only way they're going to make money is if they stick in there and perform. But you're absolutely right. I mean, today, the valuations are down a lot. Okay. So any sponsor trying to exit today is absolutely not projected to make any money. Their goal is get my common equity paid back, give them a good return, and I'm just going to have to suck it up so I live to fight another day. That's happening as we speak today. We got a deal presented to us last week, that exact scenario. We have an opportunity to pick this thing up, probably $27,000 a door below replacement cost. Okay, so we couldn't build it today but we can buy a brand new product because the sponsor has realized, you know what, the market's not going to turn for me in the next 12, 18 months favorable to me as the sponsor on a deal that we're delivering now. So I'm going to go ahead and get my investors paid. I'm a merchant builder. My business model is build it, lease it, sell it. I'm going to go ahead and call this one a victory for getting my capital back, but I need to move on and go to my next deal because he realizes that he's not going to make a back end profit in the next, you know, 18 months. So he's willing to walk away now if his investors get taken care of. So we're starting to see that model that we talked about a year ago and that we're talking about today. It's starting to happen. These loans
So,
are maturing and people need help.
so in that model, you are actually acquiring the property, or
Yeah,
you
that would
just
be just a straight up acquisition. I mean,
okay,
that's I don't call it a unicorn, but people ask me like, well, how many of these are you going to see? And I said, you know what? We're starting to see them right now. And these merchant builders, their business model is not to hold this for cash flow. I mean,
right,
they make all their money on the turn, and these
right.
turns typically 4 years. You know, build it, lease it, market it, sell it. And these loans that are maturing like now and next year, they don't have a lot of options other than like, you know what, let's move on. Let's get our money out. We're not going to be super profitable on this, but let's make sure that we don't lose money or we waste our time trying to salvage this for somebody that wants an asset that they want to cash flow it, which would be us. We want to hold these assets, you know, 5, 6, 7 years and cash flow them. And so we have a different business model, a different way we make money for us and our investors.
So let me ask you this. So you mentioned the price per door is below replacement cost. The sponsor is in need or recognizes the need to exit and return the capital to his investors. Um, when you go into this, given the current um, you know, rate environment for loans, are you coming in, in a much stronger position with a lot more equity to make the numbers work for your investors, or how are you structuring that?
That's a really good question. There has been a mushroom effect with different types of short-term loan products that are coming out on the market. And I will tell you this, underwriting these things is far different than 4 or 5 years ago. So we are underwriting these to not be incredibly profitable, but we're looking at the cash flow and we have to not predict, project, or hope that this thing will cash flow in 2 years. We have to know that our purchase price and our current short-term debt that we would put on it would support a positive cash flow on the asset. Now, does that mean I, as a sponsor, have to make a lot of money today? Absolutely not. But I have to make sure that my investors are coming in and that they have a profitable investment today. That's why instead of buying this asset at replacement cost, and the seller knows this, the seller can't take this thing out and say, okay, I know all the debt products, the seller, I'm being the seller now. I know all the debt products. I know everything that's out there. And if I were going to buy this, I would not buy it unless it was priced at this. And so they know the number and the brokers know the number and all that. So we're not acquiring something on the come. It has to work today. And we have a lot of good data. So does it have to be a 12 IRR day one? You know, we're still putting off 12% cash flow, you know, by the end of the year? No, but do we have to be very conservative and know that it's throwing off cash that we could distribute to our investors and then grow it over the next 2 to 4 years, which I think we all believe that we're probably at the bottom of this kind of, you know, financial stress trough, you know, that we're in. And I think that, you know, we'll be seeing an uptick in the next 12 to 18 months. And this is the timing that I mentioned early on in our conversation that we're somewhere near the bottom. Do we go a little lower? Maybe. But do we start ticking up? Probably.
Well, yeah, all the debt's maturing. I mean, deals have to be done.
Well,
And
$600 billion of multifamily debt is maturing over the next 36 months.
yeah,
that is a lot of apartment complexes, and a lot of those are down in the southeast. Well, I say southeast, probably Arizona, going through the Sun Belt, to include Tennessee and the Carolinas and all that below, and Texas, of course. There a lot of that supply was built, over the last 5, 6 years in the Sun Belt state. So there's going to be a lot of opportunity, Texas, Florida, where we primarily focus.
Yeah. So on the I just had a thought there. You were talking about the refinance, the return. I can't remember what it was. Anyway, so on oh, I know what I want to ask you. So are you doing these deal per deal like a syndication, or do you have a fund, or how are you?
It's another good question. We have chosen, and I don't know if it was by default, which I think it is, but we have chosen to do a deal by deal structure. And there's pros and cons on both, but in today's market, I'm incredibly grateful that we are deal per deal. I have a lot of friends that have funds. They don't have anywhere to place the money. They're having to give the money back. They're just saying, I can't make an investment that pro forma is at a 2 or 3% return. I just can't do it, So they can't meet the calls from the investors. So they're actually returning money. So our investors, and we are too, are grateful that we stuck to the asset by asset syndication model, so that people can see exactly what they're investing in. Now, in the great days, 5, 6, 7 years ago, I wish we had a fund, because I was doing a lot of heavy lifting when all my fund friends were saying, "Oh, we just have a fund. You invest in the fund and we take care of it from there." Well, today it's done at 180. I mean, we're on the
Right.
flip side of that coin, and the syndication model is a much preferred model, especially since those funds are in terrible need of product, but they just can't meet the investment requirements, return requirements.
Well, the few things I see that make a lot of sense to me are A, the demand for housing is not going away. B, you're getting into new product, which will have very little capital improvement requirements for the near future.
Right.
And you're getting it at a price, or the opportunity to acquire it at a price below replacement cost. So even while the numbers may seem, you know, out of sorts right now, just based on historical or the recent historical numbers, the the market will adjust and we will go forward. And given enough time, it will work, and it will work really well, especially without any kind of the heavy capital improvement requirements. I mean, the things new, or the opportunities you're looking at are new. They're completed. They're occupied. Um, that seems to me to be a pretty good opportunity for you guys.
Yeah, and I think in the interim, this pref equity model, I mean, it's really straightforward. I mean, it's short
Hmm.
term. It's fairly liquid. It's not liquid like a CD. I mean, like a savings account or a money market. But man, you're making close to 12%, if not 12% annualized, and you're not in it long term. I mean, you're
Right.
you're you're in it short term. You've got a really nice position in the capital stack. You got all the common equity behind you. And I still tell people, I said, look, we're getting courtside seats to see this asset perform. Do we want it or not? And you come in as a preferred equity, you're not one guaranteed that we're going to move forward with the deal, but you're also not forced to move forward with it with us. If we do to buy it, it's your option. But
Right.
you get to see everything. So you get to make money while we watch this asset mature. And then if we like it, we go for it. And if not, we move on.
Sure. So with your investors, what's a minimum amount of investment that you work with?
Yeah, we do two things. We typically stick at $100,000 per investor, but people who come in for a first time with us, we do 50,000, just so they're comfortable, because I encourage every investor that's, and I say new, in their first 1, 2, 3 years, going, with sponsors like ourselves, go out to 3 or 4 sponsors, put 50 here, 50 here, over here, and watch how they perform. Do they do what they say they're going to do? Do they follow the pro forma and the business plan? Do they communicate? all of that, because if you get in with one investor with all your money and it doesn't work out, it can be a painful few years. But if you get
Yeah.
into 3 or 4 and you say, hey, I like the way these guys communicate, I like the way they perform, I like everything they're doing, or I don't like it, at least you're not stuck with a significant amount of money and one operator. So that's why we like the 50 model for first time investors with us. But if somebody's got a couple hundred, I would absolutely break that up into at least 3 investments.
Right. And as far as for the investor at the year end, the K1 they're getting, it's reflective of interest and depreciation on the
Gosh,
preferred equity.
Darren, that's a depends. And I hate that
Okay.
because I hate it when attorneys always say depends. I'm
Okay.
like, I'm going like, yeah, but it all is the way the structure is, who signs on the debt, is the debt recourse or non-recourse, how is the operating agreement set up? But we as a group, our default is that we try to capture as much depreciation if it's an asset that we think we're going to hold 5 years or more. If it's short term, we might not do that. It may not make sense to do it. But typically our default is we leverage the depreciation components of real estate as much as we can. That's our default, but it all depends.
Got it. Got it. Well, it sounds, you know, I I guess the next couple of years sound like there's a lot of potential for a lot of excitement, a lot of potential growth, and you know, for the new investment, for the people that invested. Not, and I don't mean the people invested, but just given the change in the environment, the risk that they faced was the change in the market, and there's going to be some losses for the people that invested, more the generals. It sounds like the GPs, based on just their responsibility to their investors and that. But that's kind of the one of the things I've kind of come to understand is the beauty of the American economy is the ups and the downs is what creates the opportunities. And
It and I you can't if we're ending on something like that, I want to tell everybody that there's always a solution. Okay. We didn't do pref equity for 12 years. And because I was aware of it and I knew how it worked, I had no issues coming into this current market saying, guys, we're going to be fine. Yeah, we're not going to fund all of these developers, but there's hundreds of developers out there that need our pref equity. So we're going to pivot and we're going to fill that gap. And we're going to fill that gap for probably about 2 years, and we're going to sit back and wait. And we're going to watch this. I've told our investors this too. I said, guys, I've never made a good or great decision based off of emotions. If we stick to the data and the history and the track record and the data, the demographics, the net migration, the jobs, all of that. And if we follow the data and take the emotions out of it, we're going to be absolutely fine. And right now, that's kind of where we are. I'm more excited today than I was back in 2008 and 9. I was a little scared in 2008 and 9. I think it was a little scary for all of us that remember that. But when this whole thing started about a year and a half ago, I just kind of sat back and said, I'm fine. I'm not going to panic. It's exciting. There's going to be opportunities, and if we follow the data, we're going to be just fine.
no, well said.
Mhm.
Hey, Darren, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. And that's not an option. We look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the Fed, market, um, political, however, whatever you identify and consider to be the biggest risk. And again,
Do I have an open white palette to explain my risk?
it's a complete white palette. And just
Okay.
for clarification though, but before you go here, I just want you to know that I am not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Darin Davis, what is the biggest risk?
Yeah, and it's not a black and white answer. So, and I get asked this question, a few times, and as I look back, the biggest risk personally for me, um, was if I didn't take any. Okay, the fear. I accepted the risk by doing my first few deals, knowing I probably was not going to make a ton of money. All right. And I accepted that personally, mentally, emotionally, because I said, there's no way I can figure some of this stuff out. So the risk there was accepted risk and I took it. Okay. Education, knowledge, experience, best thing I ever did. And they were small at the time. I mean, they were big at the time, but I fast forward to 20 years. I mean, they were the greatest things I ever did. Okay. And I always think about, I've had a lot of broken bones. I was a crazy kid. I tried all kind of things. And I always thought about atrophy as an answer. Okay. When you break your arm, back in the old days, they put plaster cast on us. Today, I think you're walking around with a knee surgery 4 hours later, whatever they do. But everybody knows what atrophy is. You take the cast off, your arm's half the size of your other arm, looking at that. But I kind of sat back and said, you know what? You can either, you know, waste the time and the knowledge that you learned by doing nothing, okay, which I think is incredibly risky, or you can spend that time and knowledge to do something that will propel you and or your family to some place that you're going to go. Or if you want to take it to the next level, you can invest. And when I say invest, I don't mean like physically invest, but make that commitment and that investment in yourself and your family, to actually go out and execute. And I used to say something, I haven't said this in a long time, and actually I kind of forgot about it, but I used to say, education without execution is just entertainment. My three E's, and to me, that's the risk that I will not accept. So not really an insurance answer, but you've got to take some emotional and mental risk and even some financial risk. And I've lost money. There's no doubt about it, on my own money. Okay. I've lost money, but I look back and I'm happy that I did what I did. I learned a lot. Now, if you don't change your ways as you learn those lessons, then don't do it. Okay. But if you're willing to accept that, hey, I can take that risk, I can live with it, and I can learn and move on. That's powerful.
No, well said. The not taking a risk is could be more costly than the potential. I mean, in the upside. I mean, there's always, there's got to be upside to taking the risk, but I'm a big fan of what you've been saying. Darin, where can listeners go if they'd like to learn more or connect with you?
Well, I am so glad you asked that question. So yeah, and I'll ask you, do you know who Karl Rove is? He's a political analyst. He used to work for Bush too, George W. But
Yep.
he always gets he's old school, okay? And he always gets his little whiteboard up and he writes on it and he puts it up there. So if anybody's watching this on video, here you go. clubcapital.co/CREPN. clubcapital.co/CREPN. Okay.
Awesome.
That'll take them to a
Awesome.
landing page. And on that, there is a preferred equity 101. I think it's got 10 definitions of what preferred equity is, how it's used, why it's used. There's an example of a project on there that we have. I think it's one in Florida, maybe. But they're very similar. Pref equity is it's a fairway deal. The deals are 90% the same, so if you look at one, they're all going to look the same. So it's just an example that's out there. And then you can reach out to myself. My cell number's on there, my email's on there. Anything, and our director of client relations is on there, and she's well schooled up on everything we're doing on pref equity as well.
Awesome. Well, Darin Davis, I cannot say thanks enough for taking the time. I've enjoyed it, learned a lot, and look forward to doing it again soon.
I'm looking for chapter 2. All right.
All right.
All right, Darin. Thank you so much.
All right, man.
Okay.
For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.